The national housing markets continue to rise and house prices have once again risen over September. Now, that's 8 consecutive months now. If you've been a regular subscriber to our weekly Property Insider video chats or a subscriber to my podcast, you'd know that earlier this year, Dr. Andrew Wilson forecast the housing markets would change direction and house prices would rise. And that was when many others were forecasting property Armageddon, to be blunt. That was some of the large economists, including the banks. Well, we're well into the spring season now, and Dr. Andrew Wilson is going to share his latest housing market report. And if you want to keep up to date with what's happening in our housing markets, please subscribe to this YouTube channel and click the little bell icon so we can keep you up to date each time a new show comes out. We're now 3/4 of the way through the year, and it's unlikely that at the beginning of this year, many would have believed the resilience of our housing markets. Now, our property markets reset at the beginning of the year, and house prices have risen for 8 months in a row. And that's despite interest rate rises, high inflation, reduced borrowing capacity, and a media that was keen to warn us of housing market Armageddon. Remember all those commentators who tried to scare us about mortgage stress, a fixed rate mortgage cliff, and even a recession? Yet despite all these challenges thrown at them, property values in our combined capital cities have kept rising, albeit more slowly over the last couple of months. So I'm keen to hear the latest My Housing Market statistics for the end of September from their chief economist, Dr. Andrew Wilson. Hi, Andrew.
Yeah, good day, Michael. And you're spot on, of course. We've continued to record growth over the September quarter. The national house price increased by 0.3% over the quarter compared to the August quarter result. But the rate of growth certainly has eased, and we shouldn't be surprised at that. A couple of factors working. Affordability constraints are rising. Of course, prices in some of the jurisdictions have risen are rising towards 10% growth this year. So that impacts affordability. Of course, we have had interest rate increases, which affects affordability too for mortgage holders. Even though we're sort of in pause mode at the moment, it takes some time for those impacts of higher interest rates combined with higher prices. And of course, we still have high inflation, which we've had revealed recently. Headline inflation is going nowhere. So it's just another cost burden that the consumer has to bear. But nonetheless, house prices are continuing to rise. The national house price, as you mentioned, up for the 8th consecutive quarter this year. These are rolling quarters, of course, that we measure, but the rate of growth certainly has declined. And if we look at some of the capital city results, Sydney up 0.2% over the month, the September quarter compared to the August quarter, which was the same as that was recorded over August, the growth over August. Melbourne slipped down, just down by 0.2%, so we could say perhaps it was flat. Brisbane continues to rise, up by 1% over the month, a little bit less than the strong result recorded over the previous month. Adelaide up slightly, 0.3%. Perth continues to be quite a good result, Michael, up by 1.2%. Hobart reversed its recent declines, up by 0.3%. Darwin up 1.2%, but that Darwin market, of course, is notoriously volatile. Canberra was steady, just down 0.1%. So still growth there in most of our capital city markets. When we look at the full year results, we see Sydney up 8.3%, still leading all the capitals for this year so far growth. So that's the year to date. Perth closely following Sydney, up by 8.1%, Brisbane up 7.2%, and Adelaide up 6.2%. Melbourne's just flattened off recently, but house prices in Melbourne are still higher by 3.4% over the year so far. In terms of annual growth, Perth is up just a tick under 10%, Michael, compared to September last year. Strong result there for Perth. And Sydney up 6.3%. As I mentioned before, Hobart's tending to be a bit of a contrarian. No surprise there this year, and house prices are down in Hobart by 10% over the year. But of course, Hobart has had some strong results over recent years, and it does tend to go up when others are going down, and it tends to go down when others are going up.
Let's have a look at what's happening to the unit markets, the apartment markets over the last month as well.
As we saw last month, Michael, and the last couple of months, the unit market has flattened off. We've got to remember that units were stronger than houses last year, Michael. So I think that what we're seeing is affordability constraints also hitting the unit market following what was quite strong growth through the autumn period. But yet another flat result for the unit market. The national unit price was down just 0.1% over the quarter compared to the previous August quarter. So basically a flat result. Of course, when we look at the national prices, they are weighted averages based on sales and listing numbers. And of course, in terms of units, that means Sydney takes the lion's share in terms of that weightings because, of course, most of the sales proportionately come out of Sydney, and Sydney was down 0.4%. So that, and Melbourne up 0.3%. Brisbane debt was down 0.2%. So that's why we saw that flattening again. It was a result of lower prices in Sydney and Brisbane, but marginally lower prices. But I think it's interesting when we look at the unit market, Michael, in terms of the previous peak, the national unit price is just 0.6% lower than its previous peak, which was in autumn last year. And Sydney unit prices are down by just 1.8% compared to their previous peak in March last year. And of course, when we compare that with houses in Sydney, Sydney's still 2.4% below its previous peak in March last year. So no surprise, another flattish result, we could say steady result for units over the quarter, while the houses continuing to grow. The rate of growth is certainly easing.
Well, some people are going to say, hey, I told you so, it can't continue on. What do you think is ahead for the rest of 2023?
Well, these growth rates can't continue on, Michael. I mean, that's logical. Unless we're getting a surge in wages or lower interest rates, how can we generate affordability? I mean, we have a fixed finance model, which is one of the positives of the Australian housing market, is that we can't overborrow. So our borrowing is restricted by either higher incomes or higher or lower interest rates. And of course, we've had higher interest rates. I think that's starting to ease the market slightly, but we have very strong economies. Wages are growing at the fastest rate in nearly 10 years, but prices have increased by nearly double figure rates in a number of the capital cities, Michael. And we can't continue to sustain that and sustain that rationally and with lower risk unless we have drivers that are improving affordability. So this is certainly nothing to create negativity about, because I think this is the future. Unless we are getting lower interest rates, higher incomes, significantly higher incomes, we don't have the capacity to push prices up. And this, I think, is a positive because it gives us more certainty in the outlook.
Well, in the past, property cycles haven't started with such a bang. And you're 100% right that unsustainable to continue this almost double-digit growth in some of our capital cities so early in the cycle. Otherwise, the cycle would finish very quickly. Of course, consumer confidence has been a big part in how our housing markets have performed. And it seems like buyers and sellers are back in the market this spring season, Andrew.
Well, they are, Michael, and we're certainly seeing a lift, as we always do, in the number of sellers in the marketplace. And this could be another factor in some early signs of easing, with more choices for buyers out there now. But we had a very big weekend for the first Spring Super Saturday of the year, the pre-grand finals Super Saturday, and we actually had a rise in clearance rates. So there still seems to be plenty of capacity in terms of buyer depth for higher listing numbers. So I wouldn't be writing off our housing markets just yet. I think this is an orderly progression in terms of the revival cycle. We've moved closer to where we were a year ago. This market has been clearly in catch-up mode, which is what we saw post-COVID. Quite clearly, it's what we saw in 2019. Markets do catch up when there are those significant value opportunities. Buyers can see they can still buy at a discount now. But these things, of course, are being offset by higher interest rates, higher inflation, and higher prices. So I think it's a very positive trend, and one, again, that we could rationalise. And Australian housing markets don't have the capacity to either rise or fall, not according to the key drivers. And that's our finance model, which is a very strict finance model of the bank's borrowing regimes.
Andrew, clearly there's a number of factors driving our housing markets, including finance, as you say, availability of credit, consumer confidence, and that seems to be slowly returning, but also supply and demand. And over the last little while, net migration has skyrocketed, Andrew.
Well, it has, Michael, and the latest data from the ABS shows another rise, not surprisingly, in migration. We really are heading into uncharted waters, and that coming from a country which has traditionally had the highest per capita level of migration. But of course, what we're seeing is we're going from zero to a real surge in migration, and that's particularly impacting the rental market, and particularly the rental market that's exposed to international students, because we're seeing a surge in international students. They're being encouraged to come back to Australia. Australian universities and higher education institutions are keen to have international students back on their campuses. But the big difference now, Michael, is the net result. We're seeing a flood coming in as we normally do, but there's no net negative because we haven't had students coming in for a number of years. So we're not seeing those students typically who have graduated leaving and giving us a net result. All we're seeing is students coming in. And of course, that means increased demand for particularly rental properties, and particularly suburban inner city rental properties. And that's why we're recording very sharp declines in those areas of vacancy rates. But of course, it also works its way into the buying market, with permanent visas also rising towards record levels.
Well, your chart here shows that migration in particular has occurred in New South Wales and Victoria. But I think that when we look at interstate migration, Queensland's been the great recipient of that.
Well, it has, Michael, and the data that we show is annual data based on the quarter-by-quarter data sets. And we know that there was a flood of migration out of the southern states during the COVID lockdowns. We saw that quite clearly in the data. That's still being reflected to some degree because the latest data covers March of last year. And I still think there's still a leakage out of the southern states at higher levels into southeast Queensland from those looking to settle, but not at the same level as we've seen previously through that COVID period. And when we look at interstate net migration out of Victoria, we can see that that's really steadied as well. Even though there is still a reasonable level of net migrants out of Victoria, it's way below now where it was during the COVID period. And of course, New South Wales always leads the charge, typically through the various cycles of net loss in terms of growth. And maybe that's people seeking a more affordable lifestyle, given the high-priced Sydney market. Yeah, look, no stopping migration. It's at record levels. And the fact that we're getting higher levels of net student migration will continue to put particularly pressure on our rental markets.
I just wanted to remind you that this is not specific investment advice because we don't know your personal circumstances, but we're more than happy to have a chat to help you take advantage of this new property cycle. If you think about it, the opportunity like this to get set at the beginning of a new property cycle doesn't happen very often. So why not have an obligation-free chat with my team at Metropole to discuss your goals and to discuss your options. We're much more than just another buyer's agent. We help you safely create intergenerational wealth through property. We're big enough to tip the scales in your favour, but still small enough to care. And as we don't sell any properties, our advice is independent and unbiased. Now remember, property investment's a process. It's not an event. So you can't just go out and buy any property and hope to be successful. In fact, now more than ever, getting the right advice is critical. So if you're looking to invest in property or buy a new home, go to metropole.com.au and have a chat with our multi-award winning team. It's a great feeling having the team at Metropole on your side, levelling the playing field. Well, in our regular weekly Property Insider chats, we'll have a more detailed look at all these economic factors, how they're going to play out in our property markets. And it'll be interesting to see what the Reserve Bank does for the month of October, with the monthly inflation figure creeping up a little bit, and Michelle Bullock now at the head of the Reserve Bank.
Yes, Michael, no surprise with the inflation data, the monthly inflation data. We're now starting to see, which we've discussed for a while now, the impact of higher fuel costs. Oil per barrel is now pushing up towards $100 US. This will continue to have an impact on inflation. All we have to do is look at the price of petrol at the Bowser to see that impact. It's now well over $2 a litre. And the interesting thing is, Michael, that the price of oil is not included in underlying inflation. It's considered to be a volatile element. So it's not included in the underlying inflation model, which is the model the RBA uses for its target, the 2 to 3% target. I'm not so sure consumers will be happy not having the position of headline inflation being included in the model. So there's some difficult choices there for the RBA. I'm not a strong advocate of their policies in recent months. It is good news for consumers to see lower or steady interest rates, but it's not good news if they're forced to revisit higher interest rates, which of course they've backed themselves as a possibility because they want to cover all bases. But the other big mover in terms of inflation, Michael, was rents. Rents are continuing to surge, and they're having a significant impact on inflation. Our inflation continues to be well ahead of the US, and I would suggest that there'll be some heavy-duty thinking going on at the RBA. I think this is really an issue with central banks generally, that they've decided, okay, we're going to live with inflation. We're not going to go heavy duty with interest rate increases as we did in the 70s and the 80s and the 90s. We're not going to risk a significant downturn in our economy in terms of higher unemployment rates. But what do they do if inflation raises its head again? Because I'm sure they can't just dribble out an occasional interest rate increase every now and again, given the increases that they've had have had absolutely no impact on inflation, which unfortunately, because the only impact on inflation has been the post-COVID ending of the supply blockages, we're now in a position where we might start to see inflation rising again, and some very serious questions on the RBA in terms of their policy position.
Well, I look forward to your regular commentary in our weekly Property Insider chats. Thanks, Andrew.
I've given a lot away there, Michael, but we can certainly discuss more of that when we see just exactly what the RBA has done with the October result.
Fantastic. Bye. Thank you.
Thank you.